I'm tracking a critical anomaly coming out of the final Asian trading session of the year. Now, what looks like weakness on the surface is actually hiding a really powerful signal for the entire AI sector. Let's break it down.
So the headlines are screaming about weakness in the South Korean market on its last day of trading. And that's the easy narrative, right? It's the one designed to make you react, not think. But the underlying data, the actual flow of capital, is telling a completely different and, frankly, a much more powerful story. The money isn't running scared. It's rotating with some serious precision.
All right, let's dissect this contradiction. This is exactly where we find the real intel, in that gap between what the index is doing and what the most important stocks are doing.
So on the surface, you see the KOSPI closed in the red. For most people, that's a red flag. It looks like a bearish signal that could easily bleed over into the US session. But that's the misdirection.
Now, look closer at this divergence. While the overall index was down, the very heart of the AI semiconductor supply chain, we're talking SK Hynix and Samsung, they both closed in the green. That's not random. That's a clear message from the smart money. So what's really driving this? Why would the broad market fall while the elite AI stocks are actually advancing? We've got to follow the money. What I'm tracking is a huge foreign net sell-off, over 476 billion Korean won. That's a massive outflow of capital, and that's the number that dragged the headline index down. And here's the absolute key. This isn't a panic sell. It's a technical, almost administrative maneuver we call book closing. All it means is that funds are taking some profits off the table to lock in their annual returns. It's an accounting move, not a fear move. And you have to understand, this is fundamentally different from the window dressing we usually see. They aren't buying up winners to make their portfolios look pretty. No, they're selling their winners to turn those paper gains into real, reportable cash. It's a reset, not a retreat. So, how does this help us build the real story for tonight's US session? Well, this is the signal that's going to cut through all the noise. The data just proves it. While capital was being pulled from the general market, financials, other large caps, it stubbornly held its ground in the core AI sector. It's like the funds are cashing out, but they refuse to let go of their AI infrastructure positions. And this is where you can see that conviction. SK Hynix, which is a direct play on HBM memory demand, rallied strong. Samsung held firm. What this does is it confirms that the structural demand for AI is completely 100% intact. So this creates a direct leading indicator for the US market. Think about it. Strong, unwavering demand for high bandwidth memory in Korea is a direct signal of strength for the key US players who depend on that supply chain. I'm talking about NVDA and Micron.
So here's how we translate all this intelligence into a tactical plan. The market isn't just one big thing. Right now, it's a battlefield with very clear lines drawn for tonight's session.
There are really two clear scenarios on the board for tonight. You have the bull case, where this dip is just administrative noise before a big New Year rally. And then you have the bear case, where this selling pressure signals a genuine short-term reversal. This is the bull's line in the sand. It's their line of defense. If NASDAQ futures can hold this level, 25,650, it confirms the selling is purely technical and the uptrend is still secure. But this is the trap. If that wall at 25,500 breaks, especially with high volume, the bears take control. That would invalidate our administrative noise theory and signal a real short-term trend reversal is underway.
All right, here it is, your actionable intelligence, the specific instructions for tonight's session. No ambiguity, just the key data points you need to watch.
Your primary focus should be on the core AI semis. The signal from Asia is crystal clear. There is absolutely zero structural weakness in demand. So the directive is to hold those core positions. Do not get shaken out by this administrative volatility. Let the dust settle before you make any aggressive moves. So the core question is simple. Is this just funds cleaning up their books, or is this the first real crack in the market's armor? The data from the Asian supply chain points to a reset, and now you have the precise levels to watch to confirm it for yourself. Stay sharp.